Hi everyone, welcome back to Lab for Crypto. You have probably heard many times that supply and demand shock for an asset will result in a price increase. Bitcoin, for example, as we approach the halving, people expect the price to increase due to a supply shock. But why will it result in a price increase when there is a low supply of Bitcoin in exchanges? Many analysts monitor the amount of liquid Bitcoin and make price predictions, and this is something that many of you ask me to explain. The easiest way to explain this is with numbers and an example. We will build our own automatic market maker that sets the trading price of Bitcoin like Uniswap and many other DeFi projects that people use to swap their coins and tokens. In the description below, I will have an article from Osmosis Labs, a DeFi project built on Cosmos blockchain that you can have a look at if you want to read more about AMMs, the automatic market makers. The example I prepare purely explains how the price of Bitcoin increases or decreases based on the available supply, assuming, of course, there is a demand, and should not be considered a financial advice. I have created a Python script that we will call test automatic market maker, and after this video you will understand how the price of Bitcoin changes based on supply and demand dynamics, and know why you hear analysts predict astronomical prices for Bitcoin, sometimes due to its scarcity. Let us dive in. I will use this slide to explain how automated market makers that use the constant method work, and then I will take you to the Python script that will help us visualize better how the price of Bitcoin changes based on the available supply. You can check the available supply of Bitcoin in exchanges in many places online, including our platform. However, my aim today is for you to understand how the price of Bitcoin changes based on the supply and demand. Today, the available Bitcoin on exchanges is roughly 1.88 million. And for us to understand how the price fluctuates based on the liquid Bitcoin in our test automated market maker, we create a pool with 1.88 million Bitcoin and 81 billion of USDT. If we divide the 81 billion USDT by the number of available Bitcoin, the price of Bitcoin is set at 43,000 USA dollars, which is fine. The concept of automated market makers is built around the constant product, which is this equation, and the value K, which is the liquidity. When we multiply the number of available Bitcoin by the number of USDT in our pool, we get the liquidity. This is in the quadrillion region in our example, but depends on the pool that you're gonna have in your AMM. Now imagine there is a demand for Bitcoin because of halving and institutions that want to join the BTC range and whatever other reason. And 1 million Bitcoin is removed from the pool as people bought it. And we roughly have only 883,721 Bitcoin left in our pool. As the liquidity product has to remain the same in the pool always, we have to add USDT to the pool as the available number of Bitcoin is reduced, resulting in a price increase of Bitcoin to 195K. If we see the equation, we have the 152 quadrillion number as before, and we divide that by the number of available Bitcoin in the pool, and the USDT value we get is 172 billion. And if we subtract this number from the 81 billion that we had before, we can see that if 91 billion of USDT is injected into the Bitcoin market, will result in the price increase of Bitcoin to the 195K value that we calculated. Let's go to the Python script and see the graph better capturing the dynamics between the available Bitcoin on exchanges and the Bitcoin price, and you will surprise how fragile this correlation, this connection, let's say better, between these two values is, and how it can dramatically change the price of Bitcoin. This is a Python script of an AMM which we can play around and check the expected price of Bitcoin if we remove a certain amount of Bitcoin from the pool. And if we run the code, it will give us the expected price of Bitcoin. But I think in the graph that I'm going to show you, you will get a better understanding of the connection between the price of Bitcoin and the available Bitcoin on exchanges. If we run the code, on the x-axis, we have the number of available Bitcoin on exchanges, and on the y-axis, the price of Bitcoin in USA in dollars. Immediately, we can see that this graph is a hyperbola, which asymptotically approaches zero on the x-axis and infinity on the y-axis. That is why you see people predicting very high prices for Bitcoin if the demand continues. Today, the current price of Bitcoin is at 43,000 USA dollars, and the available Bitcoin on exchanges is at 1.88 million, as we saw also before. As people continue to buy Bitcoin and move it to their wallets, the available Bitcoin on exchanges is reduced, resulting in a price increase for Bitcoin. As we mouse over the graph, we can see how the price of Bitcoin changes with the amount of available Bitcoin. Why that is important? The newborn ETFs, for instance, continue to buy Bitcoin daily. And as they buy massive amounts daily, sometimes they buy their Bitcoin from over the counter. This transaction is not reflected into the market, as you can go, for example, to a miner and say, you have mined today 10,000 Bitcoin. I want to buy this Bitcoin. I will transfer you the money, and this transaction will not be reflected into the market. Now, what is the important thing here? From April 2024, the amount of Bitcoin that is issued daily will drop from 900 Bitcoin to 450. Therefore, institutions will have to start acquiring Bitcoin from the market because probably miners will not be able to cover their needs. And that will reduce the available Bitcoin and increase the price as we saw from the graph. If the demand for Bitcoin continues, mathematically we can see very high prices, that it's above the range of millions. And that's why it's really important to understand this dynamic. Do not forget that Bitcoin inflation is mathematically set and cannot be changed, even if the demand increases dramatically. Unlike other assets that you can increase the supply if there isn't demand, for example, if there is a huge demand for gold, you can increase the number of workers that mine gold and you will be able to satisfy your customers. However, this is something that cannot be done for Bitcoin as the inflation rate is set. And as I usually say, you will get Bitcoin at the price you deserve. Now, let's go to the platform and I will show you how you can always have a perspective on what is happening to the market using this supply and demand dynamics. In our platform, you can monitor the amount of available supply on exchanges and also monitor the net flow of Bitcoin to exchanges from miners. Miners can affect the number of available Bitcoin on exchanges when they transfer it to sell to cover their running costs or take profits. Also, miners, because are people with high holdings of Bitcoin, because they contribute to the network and get Bitcoin, when they remove Bitcoin from exchanges or add it, they can affect the price of Bitcoin. Therefore, it's important to monitor. And in general, it's crucial to monitor everything around the supply of Bitcoin because it's really scarce and get a perspective on the available number of Bitcoin on exchanges, first to gauge if the price of Bitcoin is going to increase or decrease, and second, to check the solvency of the exchange that your coins are in. For example, you can monitor the holdings of Binance and see if people are removing Bitcoin from exchanges or are adding, because usually when people are transferring Bitcoin to exchanges is to sell, and therefore the amount of available Bitcoin is going to be increased, and therefore the price of Bitcoin is going to be decreased. And this is what I wanted to explain today, and I hope I did a good job. Do not forget to like the video if you found it helpful and leave us a comment with your thoughts. Until next time, bye bye.